The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, Wednesday's trade action saw corn and wheat slightly firm, soybeans and bean oil under pressure, and a mixed day in the livestock trade. It feels like these markets largely watching world geopolitical factors more than anything here this week, with Brazil and China tightening up their relationship while we see escalations in the Russia-Ukraine war. Let's talk about all these matters and more and get market analysis today with Mike Zuzolo from Global Commodity Analytics. Mike, great to catch up with you again this week. Hope you're doing well.
Doing great, Jesse. Thanks for having me back.
I'd love to start just with the news out Wednesday, the China-Brazil agreements. A lot of these agreements, that at least the news I've seen that's come out, tied to things like sorghum, fish oils, et cetera, et cetera. But I think that's a good jumping off point for us. I've told a few people this. I said, I don't envision these agreements to have a big market impact in grains and oilseeds because, I mean, we've known that China and Brazil have been working together for several years, right? I mean, talk about that. What have you seen from those agreements, and how is it or is it not impacting our markets right now, Mike?
It is impacting us, maybe not as much as it could be, because they're dancing, as you kind of say, dancing around the fact that they're not really talking a lot about grains. They have talked about meats, especially with the new Peruvian megaport opening up in Chancay, Peru here in January. That's going to drastically reduce the amount of time that meats and grains and vegetables can get to China, and that's going to help them take on more market share, meaning Brazil. But I think what you bring up, Jesse, is real important in that the short side of the spreads continues to be the soybeans. And President Xi, for instance, said today that the Brazilians and the Chinese now have a golden partnership, or they're golden partners, the best relationship in the history of their countries. And this is kind of an in-your-face positioning, I think, in the trade side of the equation, especially as President Trump gets ready to take office again. And you can see that the Chinese chess pieces are moving around very nicely between the APEC summit and the G20 summit, which took place right next to one another, and that they're diminishing, both countries are diminishing the U.S. role in trade, if you ask me, based upon both the optics and also some of the commentary. And this showed mostly and continues to show mostly up in soybeans, and especially new crop soybeans. And I think that's the sad truth about the midweek trade today, was that November beans made fresh 4-year lows without the front end going down and taking out its August lows and making new 4-year lows.
Let's talk about that a little bit more. I'll pull up a chart here looking at the corn-soy ratio and just hit this home for us a little bit more here. As you know, we're really wrapping up harvest at this point. We're thinking about next year, figuring out acreage, very early stages of that, et cetera, et cetera. But I mean, just talk about this a little bit when you look at this chart, Mike.
Yeah, getting down below 1010 in November 25 beans, with corn and wheat trying to keep the beans elevated, succeeding to a degree in the old crop prices. But here we see in the new crop beans versus new crop corn, a 2.3 ratio. So November beans now 2.3 times the price of December corn. When you go below the 2.35 ratio, that's your purple line. I call that we're starting to buy corn acres. Vice versa, you go up to 2.45 and above, you start to buy bean acres. And so it is very early in the year for us to be dropping this low this quickly. And we're clearly wanting to buy corn acres at this point. And I think that's where we are now down, as I said, a 4-year low when it comes to the new crop November beans. But notice this ratio, we're going down to the lowest levels now since the middle of the year last year. And so we are really at a point now, Jesse, that wheat is even more important than the corn and beans. And we'll talk about that more in a minute. But at some point, that if that bean contract and new crop keeps sliding, it will pull the corn down with it. And that's really where we're at heading into the holidays, in my opinion.
Well, looking over at the soy continuation chart, just leaning in here, you see this pretty clear downtrend as I look at this chart. I mean, just to, reemphasize the point here, and this is something I've been worried about too for several weeks now. I think a lot of folks have, is just how much pressure, how much bearishness is in this soy complex, and what would that do to kind of be the boat anchor, so to speak. Even if wheat takes off to be the leader, are soybeans going to kind of keep corn in check, et cetera, et cetera? Talk about that a little bit.
Yeah, it could, but I think also we have out there the inflationary side of the equation and the hard assets, which are waking up a little bit more, given the fact that the inflation talk is coming back around by the financial markets. And the reason that is because some of the economic data would suggest that inflation is going to be coming back, and that if President Trump institutes some of these tariffs, that too will increase inflation. If the Federal Reserve cuts interest rates, that too could induce more inflationary pressures. And so it's paramount, and we'll talk about this in a few minutes, but it's paramount that the wheat, the copper, the crude oil all move higher, that the treasury bonds go higher and lead those markets higher. And that puts the lid on the US dollar. And I'm working on a client only webinar right now talking about trade and President Trump and his upcoming policies, and trying to read the tea leaves. But that's really, at the end of the day, it's about the currencies, it's about the dollar, and the trade seeing the dollar as not as a safe haven, but as something that needs to go lower because our trade balances are so far out of whack. But this chart, you nailed it right in the beginning. You notice the white down trending line there. That downtrending line in white has been in place since mid 2023. And notice that it's been now 4 months in a row we have tried to take that resistance level out. And these are the types of price actions that may be really nervous, because if we can't in 4 months in a row try and take out the price level and the resistance, we've wasted a lot of energy, and we probably have to go down instead of higher to reinvigorate the chance for markets to come back in and longs to take up the cause again and buy into it. So my undervalue level for Nove 25 beans at 9.95 is literally only about 10-15 cents away at this point. But notice back in the 2015 through 2020 time period, you go below that 9.95 $10 level, you can stay below it for quite some time. So I am very much on point with the clients and subscribers right now to get some hedging done if we don't see the wheat and the corn turn this bus around right away.
How much are you watching basis and spreads here in terms of corn and beans? Because I know, we get past Thanksgiving, we get into a very quiet time of year, it feels like, at these markets, and just wondering, could we see some increased farmers selling potentially, things of that nature here ahead of Thanksgiving? What are you seeing on the basis and cash spread side and much more, Mike?
Yeah, that is a whole nother market. Cash basis and spreads are the same as flat price in terms of importance. And so I'd rank them all three as different beasts and different factors in this marketplace that generate the ultimate price, Jesse. But I would say when it comes to the cash basis, yes, we're going to have some farmer related selling after the first of the year. There's no way around that with the amount of crop that we're storing at this point and the amount of bills that are coming up pretty quickly. When it comes to the spreads, what I've come to find out, take for instance the July corn spread right now. July is now 10 cents premium to the new crop D's corn. That's historically a very favorable piece of real estate, so to speak, and that the July is carrying a premium against the December corn. But could that be because the November beans are dragging down the December corn and the funds are making the spread look like that? That's where the spreads, to me, are not as useful as they were back in the mid 90s when I started in this business. It seems as though as we got after the financial crisis and the algo funds and the quantitative fund trading and computer generated trading started to kick into high gear, those spreads can lead you down the wrong path.
Mike Zuzolo with Global Commodity Analytics, our guest analyst here today on Market Talk. Let's go over and talk the wheat trade. Of course, the escalation of tensions between Russia and Ukraine. Big talk here the last several days. And we've seen now embassies shut down in Kiev here midweek amid potential airstrikes. We've seen the launch of US made and now UK made missiles from Ukraine into Russia. Um, using your geopolitical background here too, Mike. I mean, looking at this whole situation, what does this mean for the wheat trade?
Well, we have to put this in context of where we are in the price. And I say that to myself as much as I do to you and the listener. We're near 4-year lows still. We're closer to 4-year lows in wheat, and yet we're at 10-year lows in terms of world stocks. So when something like this enters into the fray and into the mainstream, and we have the biggest wheat exporter in the world say that they are changing their nuclear doctrine and that they could use tactical nuclear weapons because of these long range moves, missile moves that the Ukrainians are now being allowed to do with US and British support. I think we really have to wake up to the idea of our unlimited risk positions and think about holistically equity positions, commodity positions, because this is a whole new territory. This is a brand new sandbox that we're playing in now when it comes to the financial markets, because we're talking nuclear threat. And so the first thing I'm going to be watching is the idea that we are cheap in the world compared to world stocks. We have been for multiple months, mainly because of Russia. And if they would act erratically and do something drastic like that, then it would be my expectation the wheat market would shoot higher. And I want to see if the market tries to put any more premium in the cash prices before the futures. And that's why this world wheat chart is something that I'll probably start looking at more and more, Jesse, as time goes on. And you see the two dotted lines. The red dotted line is our soft red wheat price at the Gulf of Mexico. The green dotted or dashed line is the 12% Russian price out of one of their major Black Sea ports. And so I want to watch these two and also watch that Ukrainian price as well.
Thank you for framing that up the way you did as well. Watching maybe for some premium in the cash markets first over futures, because I've been sitting, I think a lot of folks have been sitting wondering, okay, all this escalation and the increased rhetoric, yet we've only put a few cents each day on futures. But to your point, maybe we should watch the cash market first, right?
Yeah, and I had to learn this lesson the hard way, and so I'm going to give my competitors a big piece of the puzzle, and that is the Russian ruble against the U.S. dollar is the number one chart to be looking at when it comes to what went wrong with the wheat market. Why didn't it rally when it tried? And it was almost always, based upon my research, because the ruble sank against the dollar. So that cash market and watching that instead of futures, I think that helps solidify the idea that the Russian ruble, if it weakens against the US dollar, if tensions get worse, then maybe the wheat market doesn't have as much upside. But if we see the Russian ruble shoot sharply higher, and we have this kind of a tension, then maybe the upside potential is quite a bit more.
You mentioned copper and wheat linking up earlier. Let's look at a chart there and walk us through this correlation. When I look at this chart, I love when you share a chart like this. The correlations are just very eerily similar here between copper and SRW wheat.
It really is, and you always appreciate the value of the dynamic of what I look at, and I really appreciate that from you. This copper soft red wheat chart, in the bottom part, the 8-week correlation of plus 95 or 0.95, that's a 95% positive price relationship between those two assets over the course of 8 weeks running. And guess what? The relationship between soft red wheat and crude oil, WTI in New York, is 0.91 right now. So these are at the top end of where they've been all year long on a short-term basis. And that's why I feel like that we could have a move higher even with negative supply demand fundamentals in soybeans if we kind of ignite the inflation pilot light in the furnace.
Let's look over the livestock trade. And coming into Wednesday, I was getting ready to scream, feeders are the leaders. I still think maybe that's the case, as we did see a little bit of green in feeders at the close Wednesday. But I know this feeder market has been on fire, pulling fats with it. There's been some interesting things, it sounds like, in the cash trade out in the countryside. So let's talk cattle. What are you watching right now? What are you seeing with this chart, Mike?
I feel like feeder cattle in the cash market right now with this retention program, I think very much in play is kind of like Bitcoin or the Wild West right now. I've been hearing numbers of 4 weight unweaned feeder calves going for $3.5+ I talked to a client just right before we went on the air, and the Kearney, Nebraska sale was seeing 7 weights go for 270, 275, or excuse me, 8 to 835 weights, not 7 weights. Going for 270, 275. That the cash feeder market clearly is leading this price action higher. The trade is very much behind the idea that between the drought relief in the middle part of the country and President Trump winning and putting away the greenhouse gas fears, you've got Wall Street that is at least playing a neutral role, hogs at least playing a neutral to supportive role, and retail beef prices are still cleaning house counter seasonally against the pork the last couple weeks in a row. So, yeah, you've got a lot of tailwinds, but it's really about the feeder cattle market. I will say, though, Jesse, this Friday and next Monday could be very important days to how long we can generate this upside potential in the feeder cattle market, because placements numbers for the October, this cattle and feed report coming up Friday for the October placements data is 100 to 107%, a very wide range. And if we would go over the average of just under 104%, that may create an environment where the lead month feeders start to pull down and don't let the back end rally as much as they have been.
And I've even heard rumors of record placements with the October numbers coming up here on Friday. So, to your point, going to be an interesting trade to close the week and start the week. Looking at this chart as well, one more thing to look at here on the video feed. D's live cattle, Jan feeders. What are you watching with this relationship right now?
Well, you notice the technicals here. You've fallen off a cliff in the D's fats versus the feeders. So just to our point, you can visually see how the feeders have been leading this market. The funds have jumped in with buying feeders against fats would be my expectation based upon this steep decline. You've essentially taken $9 to $10 off the December fat cattle against January feeders in the month of November. Now, this goes back to what you just said and a very astute point about the placements number. And testing the bull market, I think, is what we're going to be looking at if we have those big placements, and whether we go down to the next support of negative $68, that flat orange line, or whether we bottom very quickly in December fat cattle all of a sudden because of strong placements, strong marketings against very big placements. All of a sudden, this spread reverses. So this could be a very good spread to be watching from a commodity investor mindset.
Good stuff as always, Mike. I want to ask you about the hog trade as well. We found some more triple-digit support in hogs on Wednesday. Just when I thought maybe, okay, we corrected the overbought and we've pulled back here. Now we're finding a little more support again, but I just wonder, maybe we finding and defining a range in hog futures. What do you think?
Yeah, my take here, Jesse, is the higher we go between now and Thanksgiving, the more we're going to take away from upside potential between Thanksgiving and Christmas. And so I feel like that we are getting close to what would be fundamentally like $8 corn when it comes to the hog market right now, unless we find out about some disease or outbreak of something that's going to hurt a lot of pigs. But I'm very nervous about a big slide in the hogs with this kind of a almost parabolic move up here this last couple months, with China not supporting it, cutout values, belly values starting to give way, where the fundamentals, especially with the funds still now at this point a record net long, adding to their record net longs last week on the commitment to traders, probably did again this week. So I think the clock is ticking on the hog market.
Mike, as always, appreciate the insight and commentary. If you have anything else you want to add, anything to reiterate to folks, throw it out for us here on the show today.
I just say I took some time and talked about the nuclear threat in last night's blog. I'll be talking a lot more about President Trump's tariffs. South American weather is still going to be very important through the next couple months. Take a trial on globalcomresearch.com and take a look at the blog and the midday updates that I give out, and a lot of the things that I throw out that I think could help your farm and ranch.
Globalcom with 2 M's, research.com. That's how you can find Mike Zuzolo with Global Commodity Analytics. Always good to catch up with you, sir. Thanks for joining us this week, and have a good rest of the week. We will talk to you again next week ahead of Thanksgiving.
Looking forward to it, Jesse. Thanks for having me.
Make sure to subscribe to the Market Talk YouTube channel. There, you can watch our latest interviews with the top market analysts in the country, find bonus content, and much more. Just go to youtube.com/markettalkag and hit the subscribe button, or you can search for Market Talk Ag on YouTube.